Now let's begin first by looking at what's happened in other markets. If you see here on our picture on the left, this shows you our year-to-date condition of how a number of markets managed to be able to perform today. And just activate this. And if you can see over here, the Philippines so far has been down about 10.9%. But the market that really got hammered was really the S&P 500, which is off about 18.6%. And a lot of the pressure we're feeling right now is really coming from them. And realizing that there is this move to be able to lighten positions down, other markets have reverberated in the same fashion. The German DAX was down 13.1%. Japan, not so bad, down about 3.75, but it is now correcting from the high point that it stood from. Then we have the Hang Seng down by 5.5%, and even Shanghai was down about 8.6%. Now, if you look at the chart here on the right side, you'll also notice that we've seen quite a bit of these declines as we've come along. And the reason for this is really because we've seen a continuing outflow in terms of selling for many of these markets, given the conditions that we've had. And we do have the situation where we're in a high inflative environment. And because of that, interest rates have been picking up. And whenever things like that happen, of course, people start to get quite jittery in some of their investments, because the higher the interest rates goes, it does compete directly with quite a number of investment instruments at the same time. So now investors have been just skidding out, and it's really because of that that we've seen a continuous decline for many of the markets that we have here. Now, we'll start with one of the bigger ones, because this is the one where a lot of pressure is really coming from, the S&P 500. And it was quite unfortunately, like I said a couple of days ago, where we saw the S&P 500 manage to rally back to its first point of resistance, which is only a mid-zone rally. If you notice, this is the downtrend channel that it's been showing, and it only rallied half the distance, where normally it should try to rally back to the previous high band of that channel. Now, this is not a good event, because what this shows you is that the S&P is underlyingly weak, and its ability to only stop at that mid-zone and then fall back down right away tells you that there is intensified selling taking place. And simply because of that we feel that the S&P might really come back down to retest the lows that we've seen back in May, and maybe even there's still a possibility it could even break that. And if it does, then it will continue to be able to agitate other markets along with it. Now, I wanted to be able to show you this. This is a very large perspective of the S&P 500. And I tried to be able to measure out what it looked like, or what, in my opinion, of what it would be placed on an Elliott wave review. Now, normally an Elliott wave cycle will compose itself of 5 waves. Now, it's very clear to us that the US is into a bearish trend. And when I say bearish, because you can see this very bullish trend here earlier, and then there was a break in the uptrend line, and that means it turns over, and now it carries off a much more heavier corrective wave. Now, if you were to follow the Elliott wave system, it normally says along the lines of a regular, or the angle of the present trend, in this case downwards, it's quite possible they could have 5 waves into a decline. And so if we were to have measured off where we are in that 5-wave cycle, you would see the first wave here, first big rally came out as wave 2, and then the big wave, which is normally the largest wave, wave 3, and then the counter rally, which was the wave 4, not so big. Again, that's another worrisome fact. And then here we are coming back down to the previous low, which could be the onset of wave 5. Now, if you're wondering what does that mean in terms of being a wave 5, let me skip over to the right side and show you the chart of China. China seems to be a little bit more advanced in its particular swing, and let's review its 5-wave count. So again, after breaking through the uptrend line, you see a wave 1, rally wave 2, falls down to wave 3, rally on wave 4, and here's an example of what a wave 5 looks like. Now, normally the 5th wave is normally the capitulating wave, or the ending wave of a bear cycle. Now, although it's nice to hear that as it composes itself towards the latter portion of a bearish swing, do understand that this is where the highest levels of emotions can normally come in. And it's normally why we normally see capitulations come at this side. When we say capitulations, we're talking about declines that could be slightly larger than normal, enough of which to bring emotion into the game. And it's because of that that you see a hurtling down type of movement that would come in. Now, yes, that could be quite frightful, at least for markets like this. And it's quite possible the Philippines could also get a ripple effect into that. I'll show you the what I feel would be the Elliott positioning of the index later, of the local index later. But I do want to be able to keep you guys also in mind that after the fifth wave, a counter rally does come in of quite a good magnitude. Now, it may not turn this entire downtrend around, but normally a rally from here can stage itself into three. You probably get an A wave, a B wave, and a C wave, but still conduct itself to a major rally of this very large decline. And I do hope that after what we see here into the S&P 500, and if we do see especially a very emotional type of sell-off, you might want to be able to prepare yourselves for potential buy-ins after that capitulation shows, because that's when you would normally get big rebounds. But again, we'll see how that would affect into the Philippines later. Now, just to be able to merge it in with opinions of other markets, if you were to look at the European market as well as some Asian markets, as you see in this graph we have here, Europe would compose itself primarily of the German DAX here in the upper left and the French CAC index or CAC index. You'd notice both of them now coming closer to the lower end of this sideways range that they've been building, and there is a potential for them to break through those particular lows. And as these support areas would break, then again, there could be an intensification process of the sell-off. And so again, that would line up quite well with a potential wave 5 into what the US is showing. Although not all markets in Asia are exactly the same. If you notice, the Nikkei has actually been rallying quite well. I do see here over here higher lows and even maybe a slightly higher high, but it has backed off in the last 1 or 2 days. So that will probably stop there for the meantime. I think it's very hard for markets to continue to climb when they're feeling pressure from other bigger markets. And that would also be the same instance for us to try to be able to recompose ourselves downwards. Then you have here Indonesia also showing lower high. The Hang Seng and the Shanghai index have just come from recent rallies near their previous highs or rally highs. And I think they're probably encountering resistance here. So we could also see some pressure from that. And we see issues, let's say countries like India and maybe Malaysia being one of the weakest I've seen so far this year, which just continues to be able to push itself into a new low. And so all these together are not necessarily causing, does not give markets a chance to be able to breathe and rally up. And it's really because of all of these in combination that we're probably going to feel a little bit more pressure into the markets into the short term. Now, one of the other main reasons why the markets have been quite feeble is really because of the fact that interest rates have been picking up as a result of the high inflationary environment we've seen. As you well know, we've seen the prices of oil and some commodities come up in maybe the last so many months, and this has nudged up inflation. And to correspondingly try to correct that, the expectation that interest rates would try to be able to climb and try to taper that off eventually. And it is because of that that you would see the chart here on the left being US bond yields have actually shot up again after correcting, very, very slightly, and are now threatening to be able to push back into a new high over that 315 or 320 area high mark that it's hit before. And there's a good possibility that can happen because given the fact that we saw a higher than expected inflation reading from the United States a few days ago, this is the reason that we're probably going to see that. As I pointed out earlier, the expectation for higher rates are not necessarily a good thing because that may be able to curtail some of the investments people would put up into equities or even bonds because they would look at this as a direct contender to the gains that you would see there. In terms of the Philippine situation, this is the 10-year bond yield here on the right side. And if you can see the situation that you have, it's been actually dwelling closer to about 7%, doing about 6.7%. And you can see the trajectory of those yields are still very much upwards. So it's the same as in the US. So we're both trying to be able to lure in the fact that we are expecting rates to continue to be able to nudge themselves higher, and that being a direct competitor to the markets that we are currently trading. Now, looking into the currencies, this is going to be another thing that we're going to have to deal with is the US dollar has actually been rebounding quite well. Well, perhaps the reason is because, as you would see, that the rebound in interest rates in the US could make the dollar more attractive, and it's because of that that people have been taking to be able to reinsert their efforts into that greenback. And if you notice that this picture you see here is a dollar index. It's also coming to be able to try to test its previous highs. And that dollar index could really try to hit off something like 105, which is the previous high it had, and maybe possibly even go all the way up to maybe 106 or 106.70, which is the high band of this upward channel that we've drawn up. But still an upward motion into the US dollar. Consequently, that strength in the dollar is taking its effect on many of our Asian currencies. And if you were to look at the peso-dollar that you see here on the right side, you will notice that the clear upward channel is very much in place, showing you that the peso is losing value versus the dollar and continues to do so. And in fact, may be able to stretch itself up, coming closer to maybe 53.50 or 53.60 into the short term. And hopefully it can stop there and recompose, but it could still continue to move on so long as this upward channel is not violated. So again, given the weakness of that currency, if I was a foreign investor and looking as a potential investment in the Philippines, I always have to take this into account. Because if I put money into the Philippines and my currency is weakening against my base currency, then that will try to be able to cut back any gains that I would make into that particular local investment. So here's another thing that can really add pressure into the market. Now, inflation really has been the theme to be able to watch out for. And really, as we came out from the world of COVID, and maybe not entirely, but still as we've come out into that, this seems to be the next hurdle for us to be able to cross. In the United States, we saw inflation rise up to 8.6% late last week. And this was higher than the 8.3% that was forecasted. And it's because of that overperformance in inflation that the market got jarred and got shaken and withdrew relatively fast. Now, why, you might ask? I mean, 8.3 to 8.6, I mean, that's not, you might say, not much difference. But you see, it's the mere fact that prices are moving stronger than what people thought could be a tapering situation. That is what led to this particular type of unrest. And the reason for that is, if you were to notice this chart here on the left, this is a plot of the US CPI, which is an indicator of inflation in the US. And if you see the orange shaded marks on the back show you periods of US recession. What is a recession? A recession is when you would see that for 2 quarters in a row that the GDP growth slows down. And because of that, it could be an avenue that something could be triggering it. Especially in the case like this, in the US history, there has been known that whenever inflation attempts to be able to jump up quite strongly, that it generates that recessive outcome into the US economy. And you can see clearly here an upward move in inflation. Then you see those yellow dash bars showing your recessive point. Again, happened here. Again, pulled back in the market. As a cause of that because of a recession. But again, inflation climbing again. And you see it every time inflation seems to be spiking up, you would see that recessive motions come in. So given the fact that we've seen a spike up in inflation in recent quarters, that now is telling us that they're anticipating the same. We did see a first quarter slowdown in the US, and if they register one more officially, they would have registered into a recession. And this is what markets are trying to be able to build into it. Anticipating that recession, which could generate a pullback into a company's ability to generate profits, is what the market is obviously very wary about. Now, are we seeing the tail end of this inflationary spike? But I'd like to say that we are. But if you were to look at what many analysts have been trying to forecast is inflation on this chart here on the lower right side, you would see here that the dotted lines out through time have been projections by economists to tell you whether they thought that inflation would taper already. And the white bar is inflation that you see, the white line. And that telling you that despite the anticipated projections of inflation slowing down, it has not done so, and it just continued to be able to move higher and higher, and so far continues to do so today. So this is what's jarring the market and is keeping us into this bearish stand. And perhaps until we see some sort of more viable tapering into that inflativeness of prices of the goods of commodities and services, then perhaps that's the only time that we might be able to see a reprieve in terms of markets motioning finally upwards again. So let's have a look at a few commodities to try to see whether we could be around the corner into seeing such sort of tapering in commodity prices. If you would notice what we've seen over here, we do have this condition. We have oil prices continuing to be able to climb. It's recently gone up to $120 per barrel, and it looks like it's trying to target the previous high it generated, which is about $130 per barrel. Now, it might be a little bit more difficult to climb over this, but right now, since we're still seeing a rally trend, that it's something that we have to be able to keep in mind and watch out for. We do hope that it doesn't reach that high, and perhaps maybe it can attempt to pull back, because if we can do that below 115 or even 110, then that should tell us that we're probably going to see, or perhaps see, an intermediate high already in oil prices. But again, it's something we have to keep an eye on. Now, one thing I wanted to be able to show you is this chart on my right side. This is a chart of wheat. Now, if you notice, there's also been a lot of humdrum on this particular commodity, especially with what happened in Ukraine, because the source of wheat for the world market do have their greater sources coming from, of course, Ukraine and Russia. And it's really because of that that wheat prices have been very, very sharp. But if you look at the similarity between the chart of oil here and the chart of wheat, we're probably somewhere over here in terms of oil prices if you were to look at the wheat chart. And look what happened. It hit the previous high and it backed off and went all the way back down to your 100-day EMA average. We really hope that this can be the same outcome into oil, because if it can do something like that, like come from here and pull all the way back down somewhere here at 105, that could help a lot in trying to be able to stave off the expectation for inflation's running crazy. Also looking at different types of commodities, I have here Brent crude. This is normally what they source their items out in Europe. And we have soybeans, we have natural gas here in the lower right, and coffee. Maybe of all the commodities I have here, this would probably be the top strongest ones right now. But we can clearly see that the effect on sugar, on copper, on corn, on silver, quite a number of them have actually started to taper down, if not correct, more into a consolidation. And I think we need to see more of this to be able to give impact for the market, to have that safety zone and say that, okay, perhaps we've seen the worst of the commodity spike. But there's still some out there. Like I said, natural gas, oil, maybe even soybeans are still on a high track. So we need quite a number of these to be able to fall in line with some type of movements like this. Because if not, then we could still see inflation at least hang sideways. And we want that to be able to edge down to give us more comfort. Now, of course, I pointed out to you that we may be going to a fifth wave into the US, but it doesn't mean that just because that we're seeing a recession into the US, that we won't see rallies into the market. And I wanted to be able to show you some history and some of the stats that we've come up about the US market and such recessions. So if you notice the chart I have here, we call this the pain and gain chart. And these are roughly the median stock price returns taken before and during recessions. So if you notice that coming towards a recession expectation, so let's say from 1 to 6 months or even 6 to 12 months, you can clearly see that markets have been quite uneasy and have showed negative movements. But look at this. During the time that the market actually finally registered a recession, that's the time that we see the S&P 500 show a medium advance, perhaps because the market seems to be moving ahead of that expectation. And once it's finally there, it can try to revalue itself and maybe revert itself to the mean and where it should be rather than where it was extraordinarily pressed down to be. And so that keeps us hope that a potential rally, even coming off a fifth wave could still take its effect as well. Here, the chart on the right side shows you, again, these are different types of recessionary periods also in the S&P 500. And you would see that during those recessive periods, you will actually see some declines in those periods in terms of the S&P 500 index, but they're actually 54% of the time of those periods, the S&P was actually able to register gains. So although it was 50-50 roughly, that was still 7 out of 13 times. And that means that I think that the market will still have some degree of activity to be able to show us, despite these recessive threats that we're coming to look at, especially if you hammer it down too much and some stocks or some particular type of investment instruments do show their value. So keep watch of that. Now let's focus into the PSEi. Now the PSEi is clearly into a downtrending channel. You really see that a few days ago, we saw the market break down from this recovery wedge that it was doing. It almost hit resistance, but just feigned down right before it. And now it managed to be able to settle itself back down here. And I think it was slightly even lower today. Now, this tells us that the decline into the index continues as the down channel proceeds. And we do have our resistance marked up between that 6,900 and maybe even 7,000 range as a potential heavy resistance for us. And now we're going to have to be able to look for potential support because that 6,650 was broken. That's this breakdown you see here. And so that will attempt to be able to bring the market first, maybe closer to 6,380. And if really weak, then maybe even 6,000 to 5,800, but let's stand with the first level of support first, and we'll deal with this if we really need to. Now, in order for us to be able to look at that, I will also show you the Elliott wave positioning of that in a while, but this is what we've come to be able to look at in expectation of the market. So the question is, well, do we think that the market can still fall? Well, the answer to the question is still yes. Now, the reason for that is because we are still into a declining channel. It might be able to rally, perhaps after 2, 3, or 4 days of a decline, but that rally may not necessarily mean that's the end of the decline. All right, so what we want is, if the market can even rally a little bit and then perhaps continue on, I hope it does not go all the way back down to the lower end of this range. And because if it does, that's when it will hit this 6,380 area. It would be nice to be able to see this be maybe somewhere over here, all right, where it would come closer to 6,400, maybe higher, and then maybe recompose itself to be able to move it. But right now, I would say that I'm expecting maybe a 70% scenario to be able to show this kind of movement rather than this. And so we have to build this in that the market can still stay weak in order for it to be able to find a new base. And once it does, you'll probably get this particular type of signal. And this is what you need to see. You need the market to be able to build a double base or to test support 2 times and successfully rally off that. Whether it does it somewhere down here or whether it does it somewhere here, I guess it would not matter. It's more important that we see this double base to reinforce support and so that the market can use that as its leverage to be able to make or at least show at least an interim recovery. Now let's look into the Elliott condition of the index. Now, if you look at the Elliott position of that particular index, you probably see wave 1, wave 2, wave 3, wave 4, and here we are moving into a potential wave 5 situation as well. And this is a weekly chart, and that is a much longer term orientation. So declines normally from here usually can be quite extended when you look at the daily chart like you see here on the right side. So again, we have to be able to build in that there could still be some short-term weakness for us for this to be able to complete and look for that next major support site for it to be able to carry over. On the right side, this is a daily chart of the PSEi, and even with this, you can also count a 5-wave swing, wave 1, wave 2, wave 3, wave 4, and potentially wave 5. So pretty similar to what we saw into the US market as well. So the Philippines seems to be mimicking what the US is doing in terms of that position. So if this were to do a wave 5 swing, then this would probably cast itself all the way back down. I hope it's either at or maybe even higher than the previous low. We can still see wave fives that are like that, especially if your market is strong. But normally, they tend to either reach a previous low or maybe break it a bit to be able to create that sell-off effect and generate that capitulation that we probably need to see to flush the market clean of any seller and allow it the ability to be able to rebound for what we call a recalibrated rally for it to be able to recover back to its mean value. Now, perhaps a reason for why we're still saying weak is this has been the net outflows for the Philippine index. The red bars on the negative show you that these are periods in the market where we've seen net foreign selling, where the green bars show you net foreign buying. And you can clearly see there's a lot more red bars there. In fact, so much so that their actual outflows were equivalent to about 33.2 billion pesos. And again, it's very hard to be able to turn that market to go up, to be able to do that while you're getting a lot of foreign selling coming in. We need that to be able to taper down as well. And, you know, if we could see those reversals of some of the conditions we talked about, whether a tapering in inflation, maybe an easing so much of the peso rate, maybe not too aggressive increase in interest rates, this could maybe turn the tide for them. Right now, you can clearly see even the latest reading, we still have net outflows coming in. So that means we have to take this into account, that it continue to pressure the market. So in summary of those macro positions, start first with the global market that we saw, an oversold rally in the US seems to have ended and set it back down into a new wave 5. That will generate quite a bit of pressure. Europe also started backing off from resistance, and Asia also saw some signs of that, especially in the stronger issues like Japan, Hong Kong, and China. Even they started to get affected in recent days as well. Now, part of the reason, interest rates climbing as foreshadowed by the rise in bond yields. And because of that upward path that we still see, it may have paused for a while, but it continued to be able to pick itself once again. And that reverberated itself into the Philippine bond yields as well, because we are now looking at something that could tag maybe closer to 7%, 7.25%, looking into maybe sometime this year in terms of the technicals. And of course, currencies, we've seen the peso attempted to break out from a consolidation and weaken further. And that is really partly because of the stronger US dollar that we've been looking at. In fact, the peso dollar is not the only Asian currency losing ground. We've actually seen quite a bit of volatility today, especially into the dollar yen, which has hit 135, which it hasn't done in a very long time. So we're seeing a lot of this ripple effects come around to currencies from interest rates and inflation, and even, of course, the high movements in commodities. And here we are trying to hope that, of course, the $130 barrel high mark for oil is not breached, and hopefully it creates a double top situation that could cap that movement in oil, because that plays around a big chunk with commodity prices. So if we can see that end up at a high, I think that could help a lot in staging a rally for the market. Then, of course, the Philippine technicals. We did see a support breach of 6,650. That drove us back down into a corrective wave. That may cast us maybe closer to 6,380. Or if things go really out of hand, maybe even fall between 6,220 or even 5,800 in time to be able to generate that fifth wave effect. And as a cause of this, we still see outflows coming to the Philippines. But being a fifth wave, that tells us there's a potential that this could be the first, or at least the last, or the tail end of that corrective wave before a much stronger rally comes into place. So mind you, I'm saying that this could be a stronger rally, not necessarily a reversal of the downtrend. And we're only looking at opportunities like this right now, because in a decline, we cannot just say that any decline will end at any point in time. We have to prove that to ourselves. But on oversold conditions, the market can be brought to make a substantial rally. And it will be periods like that where traders like us can still make some money, even if we're coming off a very much a bearish swing. So as the index remains into that downtrend or that bearish swing, my recommendation really is to stay light, and you have to stay nimble in a market like this. If you're going to try to be able to participate, then you will wait for that oversold condition of the market. Let it show itself, let it exhaust itself, and that is when you come inside to try to buy. And if you're going to be buying names there, you probably have to be able to look at names that are of good quality issues. Yes, some blue chips can probably do that. Also make sure that the issues that you're going to try to buy has a lot of volume as it trades every day. That way it allows you to move in and out anytime you wish. Right now, it is those issues that hardly trade good volume that are really taking a beating because they're not getting any demand. And that's the reason why they could be quite slippery in these particular types of markets. So stay in liquid issues, look for good names, maybe those that are not going to be affected too much by some recessive conditions. We can talk about that later. And look for that potential basing sign for a particular rally. But again, let's take this as a major rally, and this means that you will be buying it in the oversold condition and trying to sell it when it reaches maybe the first or second level of resistance, just to offset as a reversion to the mean of that particular trend. And this is the kind of trade that we'll be doing for the time being until we can call a reversal for the market. So if we were to be able to look now at the sub-indices, let's just have a quick look to see how some of the sectoral indices have been affected. Right now, the strongest one was really the mining sector. Well, perhaps because we've seen commodity prices be relatively strong. And this particular index probably showed its strength because of the movement of semi-rara, which has been quite extraordinary in its ability to be able to climb, and some energy prices, and this is the reason why it's showed its durability. But in recent days, even it managed to be able to come down. So we do expect some reactions coming around this particular sector as well. Then we have the financials, we have property, we have the holdings. If you were to notice everything that I'm saying, all of them have just recently broke this higher lows that they've just made, and that means that they've ended the rally spirit and are now coming back into a corrective wave. So that seems to be quite the same for anything after all this. So all the other five some indices, their MACD conditions are telling me the same, to expect more corrections to come out. So that means we're going to have to really be on our toes, because it might be isolated cases that can show things that can go against what the index is doing for us. Now, this is a graph. It's a bit noisy, but let me just show you how to be able to read it. This plots off all the 30 companies that are members of the index, the PSEi index, and it breaks it into 4 quadrants. It has an improving situation against the index, then the leading situation against the index, the weakening situation versus the index, and a lagging situation against the index. And so I put this here so that you can see quite a number of, yes, there were those laggards that are trying to make rallies, but they have not been able to really cross and become a leading movement to the index. So they're just coming back to where the index is in terms of performance. But you would see a lot of the leading companies, for example, issues like PLDT, ICT, Meralco, BPI, Robinson, some of them have actually slowed down and are coming into the weakening territory. So this is very common, and some that were somewhere in the middle are now even moving into the lagging situation. So it's very clear that some of these things really do have to be able to take their time to be able to wind up all over again. So it seems to be the norm rather than an isolated case. Yes, there are some issues recovering, like maybe ACEN and Globe are trying to stage some recoveries, but they are still very much into the lower end of this, and they have not come to be able to turn above the index yet. So I've tried to be able to place each one of those 30 companies into a strategy, onto a technical strategy for you. And I've divided it into roughly four types of recommendations: either hold or buy, a wait for a pullback or a breakout, wait for a bottom, or a sell or look to sell into a resistance move. So you will notice, for example, in a case like Ayala Core, I've actually placed them in 2 categories because that means they could do either one of both. That means right now, after coming down, it managed to rally towards resistance, and there could be a recommendation to be able to lighten or sell a position there. Or you could just simply wait for a bottoming out situation to take place first before you enter. So this depends really on whether you're in it or if you're not. If you're not in it, then you might as well wait for a bottom to take place. If you're in it, you might probably want to lighten your position and then just wait for a bottom to be able to reinstate the position inside. So again, if you were to look at ACEN, ACEN now qualifies. It's either you can sell some now because it's currently rallying and now hitting its next level of resistance. And if you're looking at a potential buy situation right now, my suggestion is for you to wait for a pullback because it just recently rallied and you wanted to be able to wait for a better price or better window to be able to take it in. So I took a snapshot of each one. You can use this as your guide to be able to do it. But let me show you how to best use this in terms of an index situation and try to see to make sense of some of the recommendations we have this. And then we'll go over these issues. So for example, this is your index chart taken from last year all the way to where we are now. And you can see how some of the recommendations could change. Like for example, when you see the market is correcting and it makes first rally, it goes back down to the previous low and it retests that low and successfully recovers. So this is the type of bottom information you want to wait for, a double test of support. And then you can see prices attempt to break out from its previous high. And that's where we take a new buy. And once you buy, you just continue to hold so long as your uptrend line continues to maintain itself. And one day, if that trend line is broken, like you see here, then you engage a sell, and then you stay out of the market while it goes sideways. And here, it managed to turn down even more aggressively. So you continue to just stay out of the market during that particular time. And currently, we're still waiting for this to end. And that's why, again, here we are waiting for a bottom. Hopefully, something like this can happen before a major rally takes its course. So right now, since we are in this particular type of situation, I can't really be looking for buy and holds yet because right now your market's angle is still downwards. So until this can be disrupted, then we can only do one of two things. We either stay on the sidelines and wait for a bottom and a new opening to buy, or you wait for such pullbacks into an oversold situation, just like this. Then you try to take a buy over here with the objective of selling it whenever it comes closer to resistance. Again, here, another pullback. Wait for the oversold situation. You can confirm this by the oversold RSI that you have. And then on the rally, you buy it. Then you sell it as it comes closer to where the next resistance is. And this is what we can only do into a downtrending condition because it'll be hard for us to go, buy and hold long when you're in a downtrending situation because eventually this downtrend will just continue and continue. And so we're here waiting for a downtrend to end. Only then can we start looking for stronger positionings like this. Now, it's possible you could have some isolated stocks that could go into a buy or hold, but right now that could be a dime in a dozen or maybe even more. And so please be quite discerning in what you're attempting to do during a bearish phase. So let's just have a look at some of the graphs that we have and try to be able to make sense some of that. You will get a copy of this report so you can go through it. I will just go through a couple of them so that you can see how we attempt to be able to make a cast out of this with the recommendation. For example, here we have Ayala Corporation. You can clearly see a downtrend. It managed to make a slight rally through a sideways type of motion. And a few days ago, it started to crack through that support. So in this, we say, again, stay light or wait for a base because we're still not out of the woods over here. I mean, we're still seeing this type of decline. And here we are threatening on a break of support. This could fall back down somewhere closer to this. That would take it closer between 650 or even 600, maybe before making another counter rally. And hopefully in that counter rally, we can rally maybe somewhere to about maybe back to 700 or even 710, and that bring it back down to the downtrend line. Again, ACEN doing the same thing. You have a downtrend channel in place, but now you're at resistance. So this is why we earlier said you might want to be able to look to lighten at this area, take some profit of this run, assuming that you bought into this oversold rebound, as this might. I mean, I hope it can extend a little bit more, but if it does so, maybe all the way up to 850 if we're lucky. And if it does, I will use that as a stronger sell signal, because after that, we'll probably see prices attempt to be able to come back down and maybe move into a sideways band rather than maybe an aggressive decline. Again, AEV, same story, rally back to the high band of the downtrend channel and come off. So again, lighten, wait for prices to come back down to the lower end, wait for oversold conditions before attempting to move back. AGI, the same story. And if you notice, many of the companies we're looking at in the index are just mimicking the same situation. Again, Ayala Land did the same. Now, the difference with Ayala Land is Ayala Land went through a particularly difficult phase because it recently was subject to a reduction in an MSCI index, and it was because of that it faltered even more than what it should have. You could see this dotted line. This is where it should have stopped, but it went all the way back down here, and now we've seen a counter rally, slightly bigger than some other stocks, but only because the selling on that foreign side managed to end. You can clearly see here in the bottom all these red bars in fallen selling that drove this all the way back down here. But look what's happened recently. There has been some foreign buying coming back, and this is the reason that we saw a substantial rally. So hopefully this pullback we're seeing in Ayala Land, it might be able to come back down, maybe to a maximum of where it's come from previously. I hope it doesn't break this anymore and maybe even can generate a higher low. So in this particular case, you probably want to be able to look for a potential higher low buy or a range trade for Ayala Land after it finishes its correction. So Aboitiz Power a little differently. It broke through a downtrend line and managed to make a rally and falter back. I would treat this now as a range trade. Every time I see a downtrend line break like this, that means the immediate downtrend ends and a sideways market takes shape. And now that it's looking sideways, I can now move to potentially range trade this. That means I would be selling in resistance, trying to be able to buy back when it comes closer to the supportive area, somewhere down here. Anyway, with all the charts that I've drawn, you would see the indicated support areas. The first and second levels of support are drawn. The first and second levels of resistance are drawn. And you can use that as a guide for your ability to be able to look forward. So I'll run through the charts very quickly now, just so you can see what the ranges are. I took the liberty of drawing the lines for you so you can see exactly where all the ranges are. So BDO seems to be generating a descending type of triangle. I would range trade this, look to buy closer here, sell closer to the red line. In terms of BPI, almost the same pattern, slightly weaker. Again, selling closer to the red line, which is your resistance line, and perhaps try to be able to look if it can come back closer to the lower end. It rallied a little bit today, but temporary rebounds of this may not tell you a big thing. We need this to break out of this downtrend line in order for us to see something very different from BPI. Right now, look to range trade the band. Converge has a very big band and is currently moving downwards. I would think that support over here would be between 22, maybe even 2050 being the lower area. So for those people looking to range trade this band, do anticipate that it's quite possible we could see it somewhere over here before seeing a counter rally. Emperador has a very different pattern altogether. And this is a very difficult pattern to be able to draw out, but I tried what I could. It seems to be narrowing off. So right now, perhaps it could just stay within a narrow band. This might not be too wide for you to make money, but if you can, wait for it to pull back closer here. If it rebounds from here, then you can buy it for range trade back to the top level of the line. The PSE index is showing a consolidating band as well. I'm sorry, Globe Telecom rather. And this particular stock was quite interesting because now that it's moving sideways, we want to see which way it would break out from, whether it would crack support or whether it can break through resistance. So for now, I would buy closer here, maybe sell it closer to the top end, and only become aggressive if I can see prices break about that band. Right now, treat it as a sideways pattern. GTCAP looks a little tender on my end because this will continue. It could see itself falter back closer to the lower end of the band over here. I may have to correct this this particular number here for you because I don't think the support and resistance values were taken well, but that would be closer to about maybe 470 as a potential low side for GTCAP. We have ICT. This was actually a very big disappointment into the market because this is one of the last few blue chips that was trying to hold its ground somewhere here when everything else was going down, but even it managed to capsize on the weight of the market and breaking that 210 support, cast it back down. So I'm looking at support between 200 and 194 potentially for ICT. So we can look at that for potential range. Jollibee continues to be able to get hit by pressure. A lot of this consumer and some retail consumer stocks are also be getting hit because of the high inflation costs, which could attempt to be able to hit their input costs quite badly. And this is the reason why some of them have been very weak. So you notice the Jollibees, the URCs, the Pizza, Shakey's, they're all going through this situation because of the high movements in inflation. So just be a little bit careful, and we want breakouts from here to take place. Other than that, maybe let's just wait for a bottom to show up first. JG Summit also showing a consolidation, but also made a pattern here. This could potentially break. If it goes below 50, then we'll probably see it closer to 48.50, maybe even 47. LTG, still the same, also into a downtrending channel. Its current support closer to 820, so a break of that will probably send it back down to low band of maybe back to 8 pesos, maybe all the way back to about 760. Metrobank, also not so bad as some of the others. At least it managed to break a downtrend line here. So it didn't get to rally as much as I would want it to do so and go sideways. But instead what it did is instead of going down too aggressively, it kind of slowed down its approach. So it's still into a channel now, but not as aggressive as the previous one. So that's a good sign. At least it tells you that there seems to be a slowdown to the selling impetus. But right now, whether it moves sideways or in this reactive channel, I would still think that support levels are still closer to about 49 or 48. So have a look at that for a potential range trade. Then Megaworld, still very weak to me. It didn't manage to even rally like some property companies like Ayala Land and SM Prime, which did very well into a rally. But this one just stayed flat and even broke down now. So again, it seems to be encountering its own sense of weakness, and I don't see too heavy foreign buying coming in. In fact, it still see foreign selling coming in. So right now, I would just stand aside and wait for a new base to be made in Megaworld. Meralco has been one stronger stock, just like ICT was one of the stronger issues, but I think we'll probably come to see a correction from here as well, coming from the high band of a particular range closer to 375. I think maybe some profit taking is in order. Maybe we can look for potential buybacks between 355, maybe even 330 potentially. Monde, also a bit change, just like Converge. This stock managed to be able to get some add-ons into an index, but unlike Converge, it managed to be able to rally all the way back up to about 1650, that being its new resistance arm. It's now pulled back, and it now seems to be bouncing over an area of support, which is closer to about 1380. And as long as the 1380 holds, that shows a higher low than this. So potentially that could allow the rally to be able to generate a sideways motion somewhere in here. So perhaps a range trade between 1380 and perhaps a 1650 could be in line for Monde. MPI is also coming around and feeling some pressure in the high band. And again, I'm thinking that we'll probably see some softness inside here as well. So be a bit more wary in that it could come all the way back down to maybe 370 or 350. And maybe then we can have a look at it again for potential support. Pure Gold also cracked its small area pattern within a downtrending channel. And that also means that we could see it come back down to the lower end of the band. So lighten first, and let's wait for a new base out attempt So here's an example of a base attempt in case some of the issues might do it. Fall down, generate an oversold reading, rally first, retest support 2 times, and then come out with an oversold rally. So this is exactly what you want to see in some issues before you buy. All right, if you're doing an oversold bounce type of whip trade, this is the kind of maneuver you want to be able to look at for potential recovery that can give you good ground, maybe all the way back up to the high end of the band. Robinsons, again, we also have a downtrend channel and it just cracked off its support. So again, that's a lighten and wait for the next supportive area to be watched. Security Bank, a little bit different. There was quite a bit of acceleration down here. And I believe it was because people were speculating that in the next index reordering or realignment, there could be a possibility that this could be a high candidate to being removed and being swapped by another stock. So maybe that could be the reason why it aggravated its decline. But it seems to be trying to recompose itself. But so far, still on a reactive channel. Only a breakout above resistance of perhaps 93.50 or 95 can give us a bit more rally space, maybe back to 100. But despite that, because we look to be able to lighten back into a rally time, especially with that threat of a realignment going on. SM also recently cracked from its recovery after hitting resistance. So the same, we lighten it, wait for prices to come back down to support. San Miguel has actually done quite well. It's actually broken its downtrend line, now gone sideways, and it seems to be a nice wide band to be able to trade. That's about 10% from 100 to about 110 or maybe even 111 is a potential area. So range trade this. SM Prime, very big range. There was also a possibility of this index perhaps also increasing its weighting into another type of index as well. So perhaps this was the reason for the extension. But right now we're seeing a big band. Let us hope that it can hold in the mid-ground and generate a range trade from here to the upper band of prices. But if this 3620 area breaks, then that means that it could actually slide back down to the previous low. So just be wary of that. PLDT unfortunately cracked an uptrend line, and that particular measure tells us that we have to be able to take some profits or lighten in view that it might make a retracement back closer to either 1795, which are the lows here. Hopefully it's there, and perhaps the next one would be maybe your 200-day moving average at 1750, but ultimately the lows of this could be between 1650. So again, just like this, let's hope that it only goes in the mid zone and then attempt to be able to make a rebound from there. And finally, we have URC and we have WLCON. Again, URC, similar to Pure Gold, making a small pattern and cracking, and that's showing some renewed threat. Downtrend very much still intact. So again, I would wait for lighten. If this breaks this, we could see quite a bit of a setback with this because that could go back maybe to about 95. And so again, let's wait for a new basing pattern there. And finally, we have WLCON. Again, a little different pattern here. It had a downtrend line break. So like San Miguel, it's now angling sideways. And we hope that we can hang on over about 2610 or 26 being the support. But if that breaks, then I guess we'll have to see prices back down to 25 or slightly lower than that and complete the nature of this bigger pattern that you see. But in order for WLCON to look quite better, we would like to see it break above this downtrend line, which is currently at about 2850. So we can see a 2850 or 29 break. This could offer a new buy for WLCON and perhaps could set things a little bit more on a more aggressive rally. Okay, so that brings us into a cover of the entire index realm of stocks. And I think we can now go into our next segment of today's session.